All right, good morning, everyone. Let's get started. In our last session, we really laid the groundwork by looking at traditional long-term liabilities. But today, we're going to dive into something a bit more complex, a little more sophisticated. We're going to dissect a really fascinating financial instrument, one that kind of blurs the lines between what a company owes and what it owns. So let's jump right into our analysis.
So, let's kick things off with the big question that's going to frame our whole discussion today. How can something that starts its life as a loan, a clear-cut liability where you have to pay back money, how can that actually morph into an ownership stake in the company? This isn't just some brain teaser, it's a very real challenge in financial reporting. It forces us to look past the legal form of a contract and really understand its economic substance. And I promise you, getting a handle on this concept is absolutely essential for anyone heading into financial analysis or management.
Every single company, I don't care if it's a tiny startup working out of a garage or a massive multinational corporation, eventually hits this exact point. To grow, to innovate, to expand, you need cash, you need capital. And that need forces a really fundamental decision. Do we borrow the money, which means taking on debt, or do we sell off a piece of the company, which means giving up some ownership?
So think about it in real terms. Let's say a company wants to build a brand new factory or launch a massive new product line. Those things cost serious money. That capital is literally the lifeblood of the business. So the big question for the management team isn't if they need the money, it's how they should get it. And that decision, well, it's going to have a huge, long-lasting impact on everything from the company's risk profile to its cost of capital, and at the end of the day, its ability to create value for its shareholders.
Okay, so let's really break down these two different paths a company can take. On the left, you've got debt. This is pretty straightforward, right? The company borrows money, usually by issuing bonds, and promises to pay it all back with interest. Now, the huge plus for the current owners is that they don't give up any control. No new owners in the boardroom. But, and this is a big but, it comes with a lot of risk. The company is legally locked into making those interest payments no matter how well or how poorly the business is doing. And if things go south and the company has to liquidate, the people who lent the money, the creditors, they get first dibs on all the assets. They get paid before the owners see a single dime. Now, look at the other side, equity. Here, the company is selling off little pieces of itself, issuing shares of stock. The big advantage here? They get the cash and they never have to pay it back. There are no mandatory interest payments, so that lowers the financial risk. The trade-off? It's all about dilution. The original owners now own a smaller slice of the pie. They have to share the profits and the control with all these new shareholders. So you can see it's a completely different game of risk, return, and control.
So, looking at these two very different options, a smart financial manager starts to think, is there a way to thread the needle here? A way to get the cash we need without the really strict rules of debt, but also without giving away a piece of the company right away? I mean, could you actually create something that gives an investor the safety and security of a loan while also giving them a shot at the massive upside of being an owner? Well, that's the exact problem that led to the very clever solution we're talking about today.
And that brings us right to the heart of today's lecture. This best-of-both-worlds solution does exist, and it's a huge part of modern finance. It's called the convertible bond. And it's probably one of the most interesting and sophisticated tools a company can use, designed to live right in that gray area between pure debt and pure equity.
Now, let's look at the official definition here, because every single word really matters. First off, it's a bond. That tells you it starts its life as debt. The company is borrowing money and it's on the hook for those interest payments. But the magic words are, the holder can convert. This feature is what we call an embedded option. Basically, the investor hasn't just bought a simple bond. They've also bought the right, but not the obligation, to trade that bond in for a set number of shares at a pre-agreed price. That option is what gives this thing its hybrid nature and makes it so much more valuable than just a plain old bond.
To really get your head around this idea, think of it like this. Imagine you buy a ticket to a concert. That ticket guarantees you a seat. That's the bond part. It guarantees you get your interest payments and your money back. But this isn't just any ticket. This one has a special feature. It says that if the band's new album suddenly hits #1 all over the world, you can trade your ticket in for a lifetime backstage pass. The concert ticket is the bond. That backstage pass is the equity. You have the option to make that trade if it becomes a great deal for you, but nobody's forcing you to. That's exactly how the conversion feature works.
All right, let's flip the script for a second. Let's put ourselves in the shoes of the investor. Why would you, as an investor, even bother with this complicated thing? Why not just buy a normal, plain vanilla bond, or just buy the company's stock directly? Well, the answer is all about the unique risk and reward setup that this powerful little option creates.
And this slide right here just hits the nail on the head.
It's all about that option to participate. Let's really unpack that. If the company doesn't do so well and its stock price just sits there or even goes down, the investor's protected. They can just ignore the conversion option, hold onto it like a regular bond, collect their interest payments, and get their principal back when it's due. The bond part of the investment acts like a safety net or a floor, limiting how much they can lose. But if the company knocks it out of the park and the stock price skyrockets, they can exercise their option. They trade in the bond for stock and get to ride that wave of growth, which could be huge. It's this lopsided payoff, limited downside risk with a ton of upside potential that makes these convertible bonds so darn attractive to investors.
So let's just walk through what this looks like for an investor, step by step. Okay, step 1, they buy the bond, giving their cash to the company. Step 2, for as long as they hold it as a bond, they're getting that steady stream of interest payments. It's their baseline return. Step 3 is where it gets interesting. Now they're actively watching the company's stock price. They're constantly doing a little bit of math in their head, calculating the bond's conversion value, which is just the stock price times the number of shares they can convert into. They're always comparing that number to what the bond itself is worth. And that leads to the big decision in step 4. If the value of the shares they could get is way higher than the value of the bond, they'll probably convert to lock in that profit. If the stock is a dud, no problem. They just hold the bond till the end and get their money back. That flexibility, that choice, is exactly what they're paying for.
Okay, so we've seen it from the company side and the investor side. Now we got to run it back home to us, the accountants. If this thing is part debt and part equity, how in the world do we show that on the financial statements? This is a perfect example of where accounting has to really capture the economic substance of what's happening, not just the legal piece of paper.
We absolutely have to recognize both sides of this thing. It's a true hybrid. On one hand, the company has a clear liability. It's a promise to pay interest and pay back the principal. We call that the liability component. But at the exact same time, it's also created an equity component. That's the value of that conversion option it gave away. It's a potential obligation to issue more shares and dilute the existing owners. If we failed to show both of these pieces, our financial statements would be incomplete, and honestly, they'd be misleading.
So here's how we actually do this on the books. Accounting rules tell us we have to split or bifurcate the money we get from selling the bond. This is super important. First, the accountant has to figure out the fair value of just the debt part. How? You calculate the present value of all the future cash flows, the interest payments and the final principal payment, using the market interest rate for a similar bond that doesn't have a conversion option. Think about that. You're finding what the market would charge for a plain, non-convertible loan to this company. That value goes on the books as a liability. Then, whatever cash is left over from what the investor paid, that gets allocated to the equity component. That leftover amount is what the market thinks that conversion option is worth, and we record it in an equity account. This way, right from day one, the balance sheet tells the truth. The company got cash for two different things, issuing a loan and selling an option on its own stock.
And listen, this isn't just some random accounting rule we have to follow for the sake of it. It's about showing the true financial picture. A really common mistake students make is they just want to classify the whole thing as a long-term liability. But think about what that does. You'd be making the company look like it has way more debt than it really does, and you'd be understating its equity. You'd completely mess up key ratios like the debt-to-equity ratio, and you'd give analysts a totally wrong idea about the company's risk. The whole point of the balance sheet is to show all the company's commitments. And this dual treatment, it does exactly that.
So we'll wrap up with one last thing to chew on. We've talked about how powerful this conversion option is for the investor. But is exercising that option always the right move, even if the stock price goes up? Think about the trade-offs. Maybe the investor is a pension fund that really needs that steady, predictable interest income from the bond. Maybe they don't want the risk and volatility of the stock market. What about the fact that by converting, they give up their safe position as a creditor and become a common shareholder? The decision to convert is actually really complex. It's a careful balance between future potential and current certainty. And really understanding that trade-off, well, that's what high-level financial decision-making is all about. We'll dig into this more in our next case study. Thanks, everyone.